Hello everyone, welcome to another video from me, Nathan. In this video, we are going to talk about the volatility, fundamental news, and inflation talks that have been haunting the market among other geopolitical factors. We always use supply-demand zones to guide and influence our trading decisions and give us a sustainable competitive advantage over the long term. To start off, the markets have been very volatile year to date in 2022, with no persistent direction. Even if you own an index fund or have invested in blue chips, your portfolio has been in the red this year. However, our strategy combines a significant edge with the volatility overstating the actual move, time decay in our favor, and mathematical probability. We have had a great year as the fear index VIX has been relatively high at 30, causing the options premium to inflate. To illustrate the effects of inflation, consider the gas prices soaring every single day as the Russian crisis evolves. A year ago, a gallon of gas was at $2.50, and now it costs almost $3.70, a whopping 50% increase. Now combine this with the fact that Russia is a huge producer of oil and a prominent member of OPEC. Inflation will exacerbate and cause further spiking on prices. This puts the Federal Reserve in a tough spot as it tries to grapple rising inflation with stagnant growth in the economy. In past years, the Fed has controlled inflation with rising interest rates. But this is a slippery slope, as rising rates risk putting the economy in recession or stagflation. So far, the economy has been resilient and the Fed transiently projects a 25 basis point hike in March. The markets in general don't like the uncertainty and have corrected significantly on this news. The standard indexes, S&P 500 and NASDAQ, are down over 10% year to date. The Russian crisis was deeply thought to cause a crash in the market, and contrary to expectations, we got a huge rally when Russia invaded Ukraine. Some of the moves in this market have been purely random, and speculators have had a difficult time gauging market direction. This has been a very hard market to invest or trade given the huge bi-directional moves we have seen. Selling option premiums has been the only strategy that has worked consistently in every market condition, and the market specifically this year has been on option sellers' haven given the premiums. However, we still need to be cautious of violent moves and ensure that we are on the right side of the trades given that counterintuitive moves are very common. Now that we have a good grasp on the fundamental news driving the market, we can go over the alerts and how they have played out. We have had a 100% success rate in February on our 0 days to expiration trades. Here is how we have posted and taken the trade at the posted time. We always have a solid plan to enter the trade. Here's an example trade posted on February 18th. We entered the trade at almost $1 credit for the 42.70, 42.40 puts with a solid plan. Reason why we entered the trade is backed by probability, level 2 buying pressure, and based on supply and demand. You can see the market clearly respects these levels, and we had a nice 3% return per day for a 30-point wide spread. I usually take 10 lots netting $1,000 in gains for the day. Since the trades have a high probability of success and we can easily replicate 2% per day on the 0 DTE, there are 150 0 DTE trade days every year. Even if we achieve a max gain on 50% of the trades, we would be well above 150% per year. This is the kind of consistent returns that an investor should be targeting. We only trade in options that are highly liquid, and SPX has the highest volume among all instruments. If you're interested, please sign up and check out our trading room. Happy trading all and have a great day.